All right, we are back. It's chapter 8. We are talking about testing controls, right? So we've talked about understanding the risks. We've talked about what controls should be in place at the client. Now we're in here doing our audit. We're going to test these controls a little bit to see if what we think they're supposed to be doing, they're really doing, right? So the controls in place are supposed to be ensuring the financial statements are fairly presented, right? That they're not overstated or understated, right? So where do we find our evidence? Well, there's going to be documents and files at your client where as an auditor you can go find evidence to test your controls, right? There's going to be purchase orders, receiving reports, and vendor invoices that if the purchase order is still open, means the stuff hasn't arrived. What's going on there? What's that about? Did it get shipped to one of the employees' homes? Were they stealing it? Unmatched receiving reports. So we received something, but we never got an invoice. We didn't have a purchase order. How did we receive something we didn't have a purchase order? And unmatched invoices. A vendor sending us a bill, but we haven't shown that we've received anything. Are they trying to get money out of us, or did some of our employees take off with something? It could go either way. We should be able to look at the trial balance, right? So everybody we owe money to on a payable, we should be able to print that out, see what the balance is, see who it is. There should be a purchases journal we can look at, right? Every time something gets purchased, it gets chronologically listed in the purchases journal. And there should be a fixed asset. Again, when we're purchasing fixed assets, right, that's just another purchase. So we're not necessarily only purchasing inventory and expense items. We could be purchasing desks, computers, robots, right? So there should be a report on fixed assets that I can match up to those purchases, receiving reports, things like that. So I'm going to look at the client's data and get evidence from that. So what am I looking for? Well, I'm trying to look in these files that I talked about to figure out what could go wrong. All right, so again, going by account, and we're talking accounts payable and expenses, and each varies kind of expense account. You wouldn't just, there's not like an account called expenses, right? You'd have to go to like legal expense, salary expense, janitor expense, mechanical expense, every kind of account you can imagine. But you're looking at all of them if they're material. There's some expense accounts you would ignore, of course. But accounts payable, you go, okay, what are my assertions and what are the most important? Well, clearly, completeness and cutoff are the most important. That's how people shift revenues to other periods. Expenses to other periods, right? So I'm going to tend to want to understate my expenses, not overstate. So that's why existence, yes, we test for all the assertions, but existence is not that big a deal. People, in other words, probably most liabilities that you look at exist. People aren't going to make up fake liabilities and put them on the books. Now, it could be that an employee has purchased something and there's an an account payable on the books that doesn't technically belong to the company, right? Your client didn't buy that. The employee bought it and took it home. So it's not legally your client's liability, although the employee has tried to rip off their employer, right? So you do have to test for this other stuff, but completeness and cutoff, those tend to be the ones where management fraud is coming into play, and management fraud is more likely to be material than an employee fraud, right? So if you think about Walmart, could some employee get away with purchasing something a few $1,000s? Maybe they could. They've got good controls there, but I suppose it's possible, right? Could management get away? Could the controller get away with capitalizing a bunch of expenses at a material level? Yes. So that's the distinction, right? Yes, of course there could be an existence issue, but typically it's pretty hard to get them to be material. They want to understate. So what could go wrong? Well, liabilities are not recorded or they're in the wrong period. Those are the big ones, right? So how do we check? What controls should your client have in place for that? Well, they should have pre-numbered receiving reports. Remember this pre-numbering. That's always going towards completeness, because that's how you can tell if something's missing, right? Completeness is everything's there, nothing's missing. Well, if I'm using pre-numbered forms, and one of those numbered forms is missing, it's pretty easy to tell. Oh, receiving report 632 isn't here. So this account can't be complete, right? So pre-numbered forms go towards completeness, and of course the receiving report is matched with the down here in to test for existence. Your client should be matching that receiving report to the purchase order and to the invoice to make sure it's a legitimate transaction and it exists, right? For cutoff, that's again at the end of the period, so your client should have somebody reviewing the bills of lading to see when those things were received. That's when the liability occurs, because invoices don't always match bills of lading. They can come later in the mail, not with the thing, right? Not with the item. And so the receiver report, the bill of lading, will have when it's received. And why it's important to look at the bill of lading, I know you don't think about this a lot, but guess what? That FOB shipping point, if it leaves and it belongs to your client, when it leaves the vendor, then it's theirs, right? So look at that bill of lading will tell you, bill of lading will tell you if it's FOB shipping point or FOB destination, and you will be able to tell if it belongs to the client or not. So that's when they get the liability, when it's theirs. All right, same thing with expenses. The big problem is not all expenses will be recorded. The next biggest problem is recorded in the wrong period, and typically they're trying to push it out into the future, and they don't want it in this period. All right, so to make sure it's complete, again, there should be some kind of documentation of the expense, and it should be in the right period. And we also assume our clients are going to have controls for valuation, accuracy, and classification. So everything is going to be controlled for, we hope, at your client. All right, so once we understand what can go wrong, and we understand the controls, we can start to come up with tests of controls. Right? So depending on what we're doing, we're going to have different tests, right? So what we're trying to do is decide, are our client's controls effective, right? Are they working? Can we rely on those controls to keep the misstatements out of the financial reports? All right, so if something's not properly recorded, there should be the client controls in place. So what can I do to test it? Well, if it's separation of duties, right, like custody, authorizing, and recording, I can observe that, right? If I'm trying to test for completeness and they're using pre-numbered vouchers, well, I can trace, right? Trace for completeness, right? So there's a list of tests of controls here for the things that can go wrong. I would suggest you find this table in your book and look at it closely and carefully so you can understand we're going to be using a different test for different controls. All right? And I do want to remind you of the directionality test. I know we've talked about this many times, but as you're looking through your list of tests, and it talks about vouching versus tracing. All right, you look through your different tests, and it talks about vouching versus tracing. I want to remind you that we have to test both ways, and what we're testing for is for the assertion. There's completeness and there's occurrence. All right, so we vouch for occurrence or overstatement, right? So in this cycle, overstatement, as we've already said, is typically not the problem. Unless there's some employee fraud going on where they've purchased some stuff and that payable is not really the responsibility of your client. But the directionality testing means where do you start, right? So if I'm trying to vouch or test for overstatement, I start with the journal, right? And I say I'm going to take the sample of these purchases and go back and make sure there really was a vendor invoice, there really was a receiving report, there really was a purchase order, right? I'm going backwards and verifying that those are real obligations of the client, right? That's called vouching for overstatement, right? So if it's not an obligation of the client, it can come off their financial statements. Tracing, right? Tracing is for completeness. So that's where I go out to where this purchase started, right? Maybe to the purchase order, maybe to the receiving report when I got it, because that's when I actually have the payable, right, when I receive it. So I start with that receiving report. Oh, did I get an invoice, right? Oh, did that invoice get in the journal? So that's tracing. So doing these tests for controls is required for public companies, not required for private ones, but you usually do it anyway because you're trying to understand what's going on. And once you understand the controls, now you're ready to go on and do your substantive tests. So understanding the inherent risks, understanding what controls should be in place, and then testing by your controls by doing things like observing, vouching, and tracing. Now you understand your risk of material misstatement. And if you understand your risk of material misstatement, now you're ready to go on to these substantive tests, right? When I do substantive tests, that's where I can adjust how I'm doing my tests so I can get a better audit outcome, right? I can adjust the nature, extent, and timing of my audit substantive tests so I keep my audit risk low. So this next part is where I'm going to talk about substantive tests, and we'll talk about how you can adjust nature, extent, and timing.